Are you aware that you can save hundreds or even thousands of dollars on your tax bill? If you're a property investor, you might be interested in finding out more. So that's why I'm talking to you today. Hi, my name's Jodie Stanley. I'm a quantity surveyor and I specialise in tax depreciation schedules, and that helps property investors pay less tax. What is tax depreciation schedule? That's the topic of discussion for today. Here's a depreciation fact to start off with. Your asset will wear out over time, and the Australian Tax Office, or the ATO, accounts for this as depreciation. This is a line on a balance sheet. Lots of people have heard of it, but lots of people don't realise that, yes, you can claim depreciation on your investment property. There are two parts we're going to cover today. It's Division 43 and Division 40. Division 43 is the larger part of a building expense. It's the capital works portion. That includes things like the floor, the walls, the roof, kitchen cupboards, and the Division 40 includes things with a shorter effective life, things like ceiling fans, smoke detectors, kitchen appliances, hot water units, air conditioning, floor coverings, window coverings, and the like. So Division 43, which is the capital works portion, which is the largest expense, is claimed at 2.5% of the construction cost, and this is each and every year, apart from the first and the last year, which is prorated unless it was opened on the 1st of July. So Division 40 is the assets with a shorter effective life. This is known as decline in value. So this deals with the plant and equipment items, the things I mentioned before, which are things like kitchen appliances, smoke detectors, ceiling fans, hot water units, air conditioning, exhaust fans, garage motors, gate motors, floor coverings, window coverings, and the like. And there's many more. So there's two methods of depreciation for Division 40. There's prime cost and diminishing value. They're both called decline in value. So prime cost uses a straight line method. So for instance, if there's an asset that has an effective life of 10 years, prime cost uses 1/10, which is 1/10. So you claim 1/10 in a full year, and it's the same each and every year. Diminishing value is different. It's 2/10 if it has an effective life of 10 years. So in effect, you're claiming double in the first year. And then progressively, you show the opening and the closing value. And it's like you've turned the tap on faster. So with diminishing value, you claim more sooner, but it runs out faster. So you've got to decide which way to go. So tax depreciation, you may be able to claim a yearly tax deduction for your depreciation when you lodge your tax return. But you've got to know how much you're entitled to. So that's why you'd engage a quantity surveyor. So investors can claim a deduction for any qualifying assets, and depreciation is a cash flow exercise to help with your cash flow. We calculate the qualifying cost of your investment. So lots of people don't know, or they can get it, but also they don't know how to determine the qualifying cost. So if you're not aware of the actual cost, you would be able to engage a certain person who's appropriately qualified. So we can determine what the estimated construction expenditure associated with the building would be, so that you'd be able to claim that on a yearly basis. So it's not actually the current market value, because that's different to construction cost. And also the construction cost doesn't include the land, whereas if you do purchase a property, it will no doubt have a land portion. So while we're talking about qualifying costs, there are certain exclusions and things that won't be included. Examples of things that won't be included are the cost of land, like I explained before, cost of clearing the land, cost of landscaping. And you might see on this slide, it's excerpted from the Income Tax Assessment Act 97. It also mentions that things like earthworks that are permanent, that can be economically maintained and are not an integral part of the installation of the construction of the structure, would be excluded. So depreciation is basically like an investor bonus rent. It's an expense that you can claim without having to physically dole money out of your wallet. When you purchase the property is when you expended the capital. So this is a way that you can claim your capital back over time. So as I mentioned before, there's a difference between value and cost. The cost of the property would also include land, and an appropriately qualified person that can help you with your claims is a quantity surveyor. So in 2017, there were changes made to the law regarding claiming Division 40. So with new items, we claim depreciation as they always used to, but if they're second-hand items or don't qualify, we actually put them in a different section and we call it a deferred asset. So that is handled when you sell the property. So rather than claiming on an ongoing basis, the adjustments and claims can be made when you sell the property later on down the track. So those items aren't lost entirely. Division 43 remains unchanged, and it's where most of the value is held, so that's fantastic. So those who purchase brand new residential and substantially renovated properties or commercial real estate, or add new plant and equipment assets to second-hand residential properties, we can still claim substantial depreciation deductions as we used to prior to the changes. So why choose us? We're locally owned and operated, very experienced and qualified. I graduated back in the 2000s, and we've been working here in the Mackay region since 2004. Very professional, full service, which is personalised and friendly, and as required, we're a registered tax agent. So we're also proud members of the Tax Practitioners Board, AIQS, NTAA, QMBA and Tax and Super. This is a handy little booklet, currently, not for long, because the 2020 year's nearly up, rental properties booklet, and it treats items over 230 assets. It shows you whether they're capital works or whether they're decline in value and what the effective lives are. So basically, we help property investors pay less tax. If you want us to have a chat to you about your particular circumstances and how we might be able to help you, we'd love to. So please give us a call. The best method of contact is my mobile, which is 0411 688 002. My name's Jodie, and I'm looking forward to being of service to you.